Hey there, welcome to Be the Boss of Your Money. We're getting started. I usually like to start at 4:30, but we're going at 5, no big deal. Market finally has an excuse to go down. Here's what we know. We know that Fitch, the one of the three major credit rating agencies, downgraded US debt one notch from AAA to AA plus. It's not the biggest one. S&P and Moody's are the more important, bigger credit rating agencies, but nonetheless, Fitch is a pretty big one too. And we're wondering what kind of damage or ripple that this could have on U.S. markets, the economy. The general consensus is not much. We'll get into that. We'll get into a quick update in the market, what got pounded today, and if there are any opportunities. So let's get the show started, and we'll be right off. Here we go. All right. Thank you so much for joining me. I'm Mitch Goldberg, your host. We're going to talk real quick about what happened in the market today, why it went down. And we have Renee Rainville. Hey, long time no see. Nice to see you, Renee. Thanks for stopping by. Hey, yo, thank you. And let's get into it. So Fitch downgrades U.S. debt. Now, Fitch is one of the three major rating agencies. It's the smallest one of the three, but nonetheless, they do carry a lot of clout. So they said that they would lower the credit rating age of the U.S. debt. They would downgrade it. They put us on warning because of the deficit, the deficit ceiling, the debt ceiling that we were talking about a couple months ago. Which, oddly enough, was the biggest thing in the news, in financial news, and now nobody talks about it because it's over and it wasn't really necessary anyway. Somebody decided to put this artificial line in the sand and say debt ceiling. We have to not go above this level. It's not really having the effect of limiting debt. It's not working. We have bigger fish to fry. It treats a symptom. It doesn't treat a cause. Is what I would say about the debt ceiling. The debt ceiling, that is an artificial, arbitrary number, but it's extended into early 2025 to get past the next presidential election, and we'll have a whole other contentious battleground again. That is the key reason why Fitch downgraded U.S. debt, because they said the January 6th insurrection. They talked about the battles in Congress and the brinksmanship that takes place, and they can't keep seeing this. And then they also said this is what they should have said first. This is what they should have led with. The debt in 2007, the national debt was worth about 60% of GDP. Now it's worth 113% of GDP. So it's almost doubled in the last 15, 16 years or so. That's what they should really be focusing on, not the brinksmanship, not the political environment. What they really need to do is just be a little bit more explicit why. Now, a lot of people say it's meaningless. It doesn't matter. I agree with that. I don't think it does a hell of a lot. Treasuries are considered a risk-free asset for banks to put their money into. It doesn't mean that banks don't have a problem with them when interest rates go up and bond prices go down. Banks like Silicon Valley Bank, Signature Bank do get into trouble because when interest rates go up, their securities go down in value, and then these banks have to mark to market. Or they have to reduce the amount of assets they have, or they have to shrink their businesses. And if they can't do that immediately, then they're SOL. And that's what happened with Silicon Valley Bank and why it disappeared so quickly. Having said all that, guys, if you have any questions about what we're talking about, by the way, please hit me up in the comments. I'd love to hear from you. It's the best part about what I do. And if you don't mind, leave me a thumbs up, a heart, an applause, a wow. Okay, these reactions that you could leave help spread the joy about the good work we're doing here. It helps the algorithms move the product here out to the rest of your connections, and it's a big help to spread the joy in the financial education. So as a result, the Dow was down 350 points, less than 1%, by the way. NASDAQ had a pretty tough down day, for worst day since I guess February, down 310 points, down a little over 2%. S&P down 63 points, down 1.38%. Gold is off a little. Oil was off a little, down to 79. U.S. Treasury 10-year yield up 4%. The VIX popped up nicely, up 2 points to 16 and change. Still pretty low. We'll see if this stuff really means anything. But I think the thing to take a look at is what really got hit as far as sectors go. I'm betting right now that it's going to be the tech sector that did the worst today. So let's just, tech sector was down 2.5%, communications down 1.8%. And the best one was consumer staples, was up 0.36%, and healthcare up 0.07%. So the recession type stocks, the stocks that do well, whose earnings and revenues could typically hold up better than tech stocks and cyclical stocks in a recession, held up well. So this just brings up a whole lot of issues. The employment is strong. The U.S. government has no problem paying its bills. Tax revenues are doing pretty good in this country. They're up. So it's I don't think Fitch had to downgrade U.S. debt, but I think they want to be ahead of anything, and they're just trying to be the more conservative grown-up in the room, if you will. So that's what happened in the markets today. Now, what does this mean for you? Does this mean recession? Does this mean you take profits? Okay, so we've talked about that. But if you have gains in there's something in my eye, it's driving me nuts. If you have big gains in stocks, we always talk about this. You should consider if you need to take profits, why you take profits, and what it would mean if your big gains disappeared and went into losses. We talk about these things, and you don't just buy or sell something because you need to be a person of action and that'll make you feel better. You need to examine what's behind the feeling, what's behind the logic, the knowledge to really understand what you should do. And that might even mean letting the market go down while you're still holding on to something that you could sell, because you want to make sure you're selling for the right reason. And the right reason is to protect profits. I get that, but it's not really the right reason for the long term. The right reason for the long term is because as you get older, you get closer to needing your money, the less risk you could take with your money, because time horizon is the first determinant of risk tolerance. So these are the kinds of things that I talk to clients all day long. It's never about, I don't, sometimes, clients will say the market's too high, or the stock looks like it's too high, and this one's too low, or this one's going up, this one's going down. I generally say to people, we're not in the business of determining if the market's too high or too low. We're in the business of taking the tools at our disposal, which is stocks, bonds, mutual funds, exchange traded funds, money markets, etc. We take these tools, we put them together into a portfolio to help you build something, to build your future net worth, so that one day you could retire. Because if you think about it, when you work, you're converting your hours into money. You're converting your time into money, and then when you retire, you're converting your money into time. So that's really always the basis of what we do. And how long will this take? When will you need this money? When will you move to this transition? These are the things that I take a look at. Tomorrow, the big news is going to be after the market. Amazon and Apple's earnings come out. Those could be market moving. Those will be very, very important for the market near term. And then Friday, we get the non-farm payrolls. That's the big one that we get hourly, average hourly earnings, hours worked per week, unemployment rate. We get a lot of information. So this is all very important, and it all goes into helping the Fed, not necessarily the earnings from Amazon and Apple, but other economic statistics helps the Fed decide what it's going to do. The general consensus is, as the soft landing scenario becomes more and more believable, the more stocks have gone up. In other words, things haven't been as bad as expected. Eventually, we do need to make the leap and say, well, maybe we have to get into a point where things are better than expected, because numbers are good. Companies eventually have to deliver on the high expectations that their stock prices are indicating. And that, to me, is the kind of thing that could really end a bull market. I don't think we're there yet. I think it's too early to tell. I still am on the side of the fence that says we are going to be hitting new highs this year. I could be wrong, but that's where I'm going, okay? And what I tell clients is you're not going to make your financial decisions based on the rest of your life on my thought of where I think the market goes or not. The tough thing right now is when a new client comes in and they say, here's our money and invest it, and they're excited and they see returns. Sometimes they heard about me from a friend or referral. The toughest thing is that people often do this when the market's really good and they're just walking right into a down market and setting themselves up for disappointment. So you really have to lower people's expectations and let them know that the reason the referral source recommended me is probably because we have a lot of stocks that we bought 15, 20, 25 years ago, and they are doing incredibly well over time. And that's what it took. You know, when someone says, oh, I'm up so much in the stock, I can't believe it. Yeah, because we bought the stock like 20 years ago, 15 years ago. That, that is really the determinant of how the portfolio is doing. So what I tell people is it's not that I'm going to tell you what to do. I'll tell you what to do with your money, with your assets in the beginning. But after that, it becomes telling you what not to do. And if you think about it, that makes perfect sense because the less you do as an investor, quite often the better your returns are going to be. So that's really the big news today. The perspective is that, people worried Fitch downgraded the U.S. debt. I think it was more of an excuse to do some profit taking. It doesn't change interest rates. It doesn't change what banks could do as far as what securities they hold. It doesn't really change anything. Some people are going to get upset and say we have too much debt. Some people are going to say we could manage it. It makes sense that the U.S. debt would go up. But when it goes up so much as a percentage of the economy, that's when it gets scary because, as the U.S. debt goes up, the economy is getting bigger also. So we shall see what the next move is from the Fed. But if the Fed keeps raising rates, they do lower the value of the Treasury securities that the Federal Reserve holds, that the Treasury could hold. We just have to wait and see. Personally, my goals are in the long term, and I'm not really reacting to this news all that much. And the best plan is when you have already been proactive to expect these kinds of hiccups. This way, when they happen, you already have a plan in place, which often is to just sit with what you have and do nothing. We will be back tomorrow. Thank you so much for joining me. Have a great day.